So interest rates have dropped. The Federal Reserve Chairman Jerome Powell has announced that they have reduced interest rates by 50 basis points. What does that mean for you in terms of your economy, the inflation, mortgage payments, um, any kind of payments? What does the Federal Reserve reducing payments actually mean for you as a consumer? What does it mean for you as a home buyer? What does it mean for you who have purchased a home? Hi, I'm Kevin Jefferson, the People's Lender, and tonight we're going to discuss the interest rates dropping. Currently, we have interest rates that are the lowest they've been in 24 months. It was 20 months last week. Now it's 24 months, right? What does that mean for you as a consumer? That means now you have more purchasing power. You have more buying power if you're potentially looking to qualify for a home. Also means that you have more buying power if you're looking to buy a car, your student loan debt, all of those different things. What you want to do is not buy a car first. Definitely, even though interest rates are going to drop on car sales, student loan debt, um, credit card debt, all of those things, because the Federal Reserve has dropped the interest rates by 50 basis points. Um, what does 50 basis points even mean? If you had an interest rate on, if interest rates on a car were 6.5%, and they dropped it 50 basis points, you're probably looking at a 6% interest rate on your car in terms of if you're looking to get a new one. But before you go out and buy that car, you definitely want to make sure you try to qualify for a home if that is your goal. If your goal is to become a homeowner, I would utilize that as the first step to changing your situation. I would not buy the car first. A lot of times I see people who buy cars and say, "Oh, I purchased a car, said that my score was blah, 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 and now I think it's time for me to purchase a home." And typically, it doesn't work that way in reverse, right? It's usually the other way. You buy the house and then you go buy the car, right? Um, what we what we have to understand is that in order to still qualify for a mortgage, you still have to be mortgage ready. And we've been talking about this for maybe the last 2 years about interest rates coming down, seeing low rates. How does it affect you as a home buyer? And I'm hoping that you guys and gals that have been listening to me over the last 2 years have begun to start, or have begun working on yourselves, working on your credit, working on your finances to put you in position to be able to purchase a home. So, the Federal Reserve dropping the rate should help spur the economy. Um, should help, you know, increase not just the economy, but also help with home sales. It may change some people who have purchased homes that have 3% interest rate. It may change them staying in the home longer because now they can get right now I quoted a person today at 5.75% with no points. So they probably could get to 5%, but it would cost them 2 percentage points, right? In this market, people have been used to paying percentage points. And I'm not saying don't pay points, but if you do pay points, you have to look back at when will I recap my when would I recap my points? When would I recap the money that I put into it? So those are some of the things you have to take into consideration. I had a person called about rates. I told them to be 5.75%. They told me that was still high. Tell that to a person who's got an 8% interest rate. Tell that to a person who's got a 7% interest rate, right? Um, you know, 5.75 is still comparably low. Where else or what else can you do and purchase something and get a 5% interest rate? You're not getting a 5% interest rate on a credit card. You're not getting a 5% interest rate on a car. Heck, some people don't even make 5% more on their money they have in the bank. Most of them don't, unless you have a high yielding savings account. And you don't even get a 5% raise on your job. So 5%. It seems you're never going to be able to please everybody. Will we see the 2-3% rate? I don't know. In my professional opinion, I don't think so. But yeah, I wanted to hop on, discuss rates, discuss the changes, discuss what that means for people who are looking to refinance, people looking to purchase a home, people who were on the fence, people who were waiting for rates to drop. I just wanted to come on and discuss it. The biggest thing is interest rate in terms of the Federal Reserve lowering interest rates does not have a direct effect on mortgage interest rates. And that's a huge misconception, right? It does affect your student loan interest rates. It does affect personal loan student rates. It does affect credit card rates, car payments, different things like that. It does affect those rates, but it does not have a direct effect on mortgage interest rates. What has more of an effect on mortgage interest rates is inflation and the jobs market, because interest rates for mortgages are backed by treasury bonds. So the fact that Jerome Powell said that interest rates are dropped, it helps indirectly, because now you're not paying as much for groceries, you're not paying for as much for car. You can potentially go out, refinance your car, and get a lower interest rate, depending on what it was at the time, as long as your credit is still in decent, standing, in terms of qualifying for those things. And it could, that interest rate drop does help you have more disposable income, more cash that you can use and qualify for, to qualify for a mortgage. If you are out there and you're listening and you have a question, I will get to them for sure. Drop the questions in the chat. I love when you guys ask me questions. It helps these sessions go by fast. While we're at it, I did want to discuss, joining our Facebook group. So we have an amazing Facebook group that we post in 5 days a week, discussing different things pertaining to mortgages, asking questions, educating you guys, getting feedback from you, and just creating a community that allows for us to kind of get information from you and give information to you. The link for the Facebook group will be below. Make sure you join. Make sure you tap in. Also, we have an amazing newsletter that we put out twice a week, sometimes 3 times a week. The newsletter will notify you of different things happening in the real estate space in terms of mortgages, qualifying. It answers questions for you. And it also lets you know when I'm going live, if I put out a video, when I'm going to put out another video, when I'm going live, joining the Facebook group and the Facebook group and the newsletter helps me give you information. Every time I go live, a lot of you guys may not be able to jump on, or if I post in the Facebook group, you may not be on Facebook like that, but me being able to communicate with you in other ways will help, you along in your situation. So again, if you're not a part of the Facebook group, I would advise you to become a part of the great community. If you don't receive the newsletter, I know you get thousands and hundreds and thousands of emails on a weekly basis, but this is something that I think is helpful and meaningful to you guys, in terms of being able to purchase the home, and it gives you information that you can utilize and news that you can use, right? So that's the Facebook group as well as the newsletter that we have. We got our first question. Hey, Kevin, do we need to show money in our bank at the time of our application? Preferably, yes. Yes. I'm gonna say yes. Some money, showing some money, yes, but if we're doing the application to see where you need to be or to see where your money's coming from, that's a part of the consultation, right? So you do the application. I take a look to see how much you qualify for, if you qualify. So let's say in perfect world you qualify, and now my next question is, Chanel, where is your money for down payment and closing costs coming from? Now you have an idea of what you need. If you qualify for $300,000, your down payment's going, and you're going FHA, your down payment's going to be $10,500, right? If you're going conventional, and you put down 3%, your down payment is going to be $9,000. So, now okay, I need 12,000, I need 10,500 or 9,000. That's my down payment for whether I go conventional or FHA. If you go bank statement loan and you got to put 10 to 20% down, now you're talking about either $30,000 for 10% of 300,000 or 60,000, which is 20% of 300,000, depending on what your credit score and your debt to income ratio is, right? You also, depending on where you are, will depend on how much your closing cost is. I say, I hear people say have 6-7%. You might want to have 7.5% for down payment and closing costs. That is just a rule of thumb. That is not etched in stone. The closing costs you need for Pennsylvania is going to be different than if you buy the same type of house in Delaware versus you buy it in Florida. You see what I'm saying? So you're going to be in different markets in terms of you're going to be in different markets, and when you're in different markets, your down payment and closing, the down payment is always going to be the same for whatever program. Closing costs will vary. Even if you're in the same town in Pennsylvania, if you're in city limits, your closing cost is going to be higher than if you're just in county limits. But that's a great question. Any more questions out there, guys? Definitely drop them in the chat. Let me know what questions you have, concerns you have. If you're out there and you don't have a question, but you want to join in on the poll, I'd like to know if you guys are excited that interest rates have dropped, or if it doesn't matter to you as much, you're more looking for home prices to drop. I'd love to get some feedback on which one you're more concerned with. I'm pretty sure the answer is going to be both, but if you had to choose between house prices dropping or a lower interest rate, which one would you choose? And if you're watching the replay of this, do me a favor and answer that question as well, because I do check my chats and my comments on a regular basis. It says, do you have to show money for down payment and closing if you plan on using down payment assistance? Not necessarily in terms of down payment, because most down payment assistance programs pay the down payment. So if you're using the down payment assistance program and they take care of the 3 or the 3.5% requirement for FHA or conventional financing, that's fine. Fine, right? We have where the down payment's coming from. Now you have to show the closing cost. Well, Kevin, I'm going to ask the seller to pay the closing cost, but they don't have to. So let's say your closing cost is $12,000. They don't have to pay $12,000 for closing costs. What if they come back and say, hey, I only want $6,000. They want to pay $6,000 for closing costs. Now we're under contract, right? And your earnest money could be on the line. So I always want to have a game plan as to where those funds are coming from. Where, are you getting a gift? Is it coming from your 401k? Is it a combination of you asking the seller and 401k? All of those things you need to know I like to have a plan ahead of time, so we're not looking like deer in headlights when we need money at the end because something happened. So hopefully that makes sense, Mia. But I say plan to have some funds available for closing costs. And hey, Depending on which down payment assistance program you use, it may go away during the transaction. So then you have to have a game plan for that as well. Not likely, or we could always pivot to a different one, but at least have the money for closing costs. And when you get pre-approved, we check to see if we can qualify you for a down payment. Alva said, for me, I prefer home prices, but either way, I'm planning on purchasing this year. I'm ready. That's what's up, Alva. I'm ready for you to purchase too. Mom of four, I need interest rates to drop. I'm excited. They're coming down some for sure, Mom of four. They've interest rates have come down pretty well. You know, they were, at one point this year, they for FHA, they were in the sevens. And now low sixes, high fives, that's those are significant changes. We hadn't seen these since February 2022. So, rates are definitely getting lower. So we're in a decent position. Definitely a decent position. If you back out of a contract, example, the seller wouldn't make necessary repairs, can we still use the same pre-approval for another home, or do we have to start the process over? That's a great question. Pre-approval is good for any house. So if your pre-approval amount is $350,000 and you apply for 123 Main Street and you don't get 123 Main Street for whatever reason, you don't have to reapply. Now, if you're under contract and you went through processing and underwriting, most likely you'll have to go back through those processes again. It won't be as tedious, but you can use that same pre-approval to buy, another home. Okay. Yeah, I'm sorry. I saw your email and I said, let me finish what I'm doing, but I did not respond to it today. And I know it came in the other day. But no problem. I appreciate you jumping on here asking the questions because it got us started with questions. We just need one and then it gets us moving. A lot of times the lender will give a pre-approval letter for each house you see. I don't like that. I prefer just one letter, but every house has different taxes and costs, so I get it. Um, yeah. It, it I don't have to give a different pre-approval. I do want to see the numbers. If for some reason the house is the taxes on the house are a little higher, typically a good agent can let you know that as well, meaning, hey, just realize that the taxes on this house are $100 more a month versus what the previous house was, and Kevin told you that your payment was going to be, $2,000, but with this it'll probably be about 2,100. So just you don't have to. Um, I I don't like giving a pre-approval for every house either. It's a tedious process, and some people, they look at houses, and the house might be 279, 280, 281, and they want a price on each one of them. It's only a couple dollars different. So I try to give the price for 281 and understand that if it's less, it's going to be different. And the monthly payment between 28, depending on what the taxes are, but between 281 and 279 is only a couple of dollars. So it's not like we don't have to keep trying to price it out. And sometimes it's hard to tell a client that because you don't want to feel like you're not servicing them, but it takes more time than people think because we got to rearrange numbers, we got to go in the system, change it, and yes, it's a part of our job, but it's tedious. So I'm not a fan of doing that. I think if I give you a couple price ranges, it gives you an idea of where you need to be. And to be realistic, if $20 a month difference affects your payment or determines whether you're going to buy a house or not, we need to reevaluate whether we're ready for home ownership. How do I know if it's a good time to refinance my car to lower my DTI? I have a 6-year term, but I have 5 years left on it. Good question, Miss Cynthia. So before you let anybody pull your credit, I would go to, if you're a member of the credit union or a credit union, um, I would talk to them about rates and terms, just give them an idea. And when you go apply for, when you go to refinance the car, you want to make sure that you don't get shopped, you don't shop around too much. Maybe try your bank, but have a conversation with them. Try a credit union, and then possibly try Capital One. Out of the three, Capital One typically going to be the highest in interest rate. Credit union and bank probably going to be neck and neck. Credit union might be easier to refinance and may have the better rate. But I would I would potentially look now and have that conversation with them. I do want to tell you, Miss Cynthia, that your score could potentially go down because you paid off a debt. With your car and you're not having it that long, it may not be significant, but I would just double check with them first before I let anybody pull credit. Go to a credit union. Hey, I've got a 680 credit score, got a 5-year term on my car. This is my car, yada, yada, yada. And what do you think the estimated interest rate would be on this car? Because I'm looking to potentially refinance. And then how much would I be saving per month? Okay, no problem. You guys out on the road, I guess. All right. So let's reset the room. What do interest rates dropping mean? I put near you. What do interest rates dropping mean for you? Um, I'll definitely have to edit the title. But what does it mean for you? I don't know why I put near. Um, I know I could have did it later, but I want people to see the title. Um, I'll change the title. So, hey guys, if you're out there and you have questions pertaining to home ownership, have questions about the interest rates dropping, what if you're just joining, what are your feelings on interest rates dropping? What do you feel about housing prices? What are some of the things that you guys are thinking and feeling? How are you feeling about the economy? How are you feeling about home ownership? Is it within reach? Do you think it's far-fetched? Are you in the beginning of the process? Like, give me some feedback in the comments of what you think about home ownership. While you're not able to physically talk to me and verbally, voice your opinion. I'd like to see some of you guys' feedback out there. We got 14 people watching. We got probably 4 people who asked questions. The ones who have not asked a question and you're watching, are you here supporting me? And if so, I definitely appreciate that. I love you guys. But if not, if you're here and you want to learn, give me some feedback on what you think of the market, when you plan on buying. Like, I'd like to see what's going on in your mind as a home buyer. If you currently own a home, are you interested in refinancing? Just trying to get some information from you guys as to what you're thinking, how you're feeling about this market. I will tell you that a lot of home buyers want to see both. So interest rates have been coming down. However, they're still looking for housing prices to come down, right? Let me give you a secret, a tip, not necessarily a secret. All sellers may not be able to do this, but some may. So if a house is listed for $300,000, you have the ability to offer a little bit less. Now, do I say offer 275? No. Like, you can, but the likelihood of that getting accepted by the seller is slim to none. 285, $290, just to see if the seller is willing to give a little bit, could be an option. When you're making an offer and when you're making an offer and you need closing costs, you're going to want that offer to be strong, right? Because if the house is listed at $300,000, you offer $290, and let's say $10,000 in closing costs, to the seller, in their mind, they're losing $20,000, because again, the price is coming from $300 to $290, which is $10,000. Then you're asking for $10,000 in closing costs while you're financing it, because your loan will be that amount. Technically, it's $10,000 less that the seller's getting. So if the seller's giving 10 and they dropped it 10, to them they're losing $20,000, because in their mind, I had my property listed for $300,000. Now essentially, I'm netting off of $280. So that's, those are a few things to look for. Definitely would, if you're interested in trying to be in a home before the holidays, you have time. I would apply. I figure out what I need to do. I would check and see about my lease agreement, and then I would just apply and see where you stand, and if you can become a homeowner in that time frame. Got a question? Does FHA take your credit score into consideration as far as interest rate they give you, or is it a set rate no matter what? That's another great question. So your credit score does have an effect on your interest rate. A person, and whether it's number wise, right? So if a person has a 580 credit score and their interest rate is 5.75%, or they want to get 5.75%, and then a person has a 640 credit score and they get a 5.75% interest rate, what they pay for that rate is going to be different. Meaning, in discount points, what the 640 credit score is going to pay less in discount points than the person with the 580. Typically, let's put them in the same bracket. If they're both qualifying, let's say they both qualify for 250 and they're looking to buy a house, the interest rate they could be the same, but to pay to get that interest rate is going to be different. So it does play a part in your interest rate. So, it also depends on what you want to spend. So just remember, and I say it all the time, the higher the rate, the lower the discount points. Typically, the lower the rate, the higher the discount points. But it also depends upon what your credit score is. But that's a good question. We also want to take in consideration that home prices they're higher. They're higher than they have been, and in certain parts of the country, like I say all the time, we're seeing home prices cut. But sometimes the seller is just waiting for an offer. They may not have put the price down, because sometimes this is some seller's thought process, right? I don't want to put it on the market. If I'll take $295 and I know they're going to negotiate down, I don't want to put it on the market for $295, because then they're going to try to offer less. But I know I'll take $295. So they say I'll give them some negotiating room, and I will put the house on the market for $305. Sometimes that works, sometimes it doesn't. To a person looking at a $290,000 house, a pre-approval of $290,000, they're most likely not going to see a house for $305. Maybe $300, depending on who the agent is, but $305 is slim to none, right? And I'm not saying you have to put it on the market for what you're willing to take, However, just understand that there's certain pricing points that people don't look over. A person at 275 probably isn't going to go see a house for 305. Now they may see it and want to take a look at it because they've seen it online, but in terms of going in and physically looking at it with their real estate agent, most agents probably will not check and see with the seller or show you that house because it's too far out. Now, what they may do is they may come back to me as a lender and say, "Hey, Kevin, um, Miss Smith saw, a house for 300,000. I noticed it's 275. What's the highest you can get?" Here's what. So this is what I would do. I would ask, "What are the taxes on the property?" And then I would get a quote on insurance to see if the insurance is lower than what I estimated or higher than what I estimated, and what the taxes are. And then from there, we take those a little bit more accurate numbers because we have a property and we see if they can qualify for that house or if, you know, how much closer they can get to the house. Okay, the first house we looked at when you qualified for whatever I said, 275, it had an HOA. This one doesn't. We can back that number out. The taxes are a little lower. We can adjust that number. Here's what the insurance is. Okay, maybe I'm willing to take a little bit more, spend a little bit more money and buy down the rate a little bit so I can get a tad bit closer and then go from there. So sometimes we do those uh things to get it. Like with a lender, a good lender, I'm not saying that you should do that on every property, but if you really like it, do it on I'd do it on a property just so we can kind of see and button up and see, because the pre-approval just gives us a range. Once you start seeing houses, it's more specific because you have a house, okay, you can get a quote on insurance on this property. You can look and see and get a better idea of what taxes are. Because in the pre-approval, we're estimating everything because we don't have a property and we don't know what taxes are. We just go by, let's say, Shamika's in Chicago. We go by what the taxes typically are in Cook County, and we look at homeowners insurance and kind of say, hey, this is where we are. But I always give the disclaimer, depending on taxes and insurance, your payment could be higher, it could be lower. It just depends on those taxes and insurance. I'm in Chi-Town. Do you know what the interest rate for a conventional loan? I'm looking to refinance a 6.5% interest rate. So it depends. If your rate is 6.5% on a conventional loan, you could probably buy it down some and get it a little lower. Um, I'd be willing to take a look to see what we could do. Two things. So when you refinance, you save money. You could save money a couple of ways. You could save money because now you might be able to get a lower insurance quote. In this market, it's kind of tough. You can save money by getting a lower interest rate, and you can also save money if you have enough equity in your property. You can save money from maybe getting rid of mortgage insurance. So, Tamika, I would check. You could check with me and see if we could get you anything any lower, and see if it makes sense to refinance. If it costs, let's say it costs a couple $1,000 to get a interest rate that makes sense, and you get rid of your mortgage insurance, then okay, how long will it take for me to recoup what I refinance for? Now, if we're doing a regular refinance, like a rate and term or a cash out refinance, then typically if the house appraises for enough, your closing costs you'll pay, but it'll come out of those proceeds from there. So it typically doesn't physically come out of your pocket. And you just kind of see what the cost to recoup that is. Let me give an example. So let's say it costs you $6,000, $6,000 to refinance. That doesn't include, just a generic number, but you save $100 a month. Oh wow. Um, that takes 60 months. So that $5,000 $6,000 that you pay for closing costs, will take 60 months to recoup because you're saving $100 a month. So that means you need to stay in the house for at least 5 years in order to recoup your money. So if you don't plan on staying in the house for 5 years, I probably wouldn't refinance, but you could, because you never know. You just never know. Or, you could gain equity and recoup it. Wow. Anna A. Love, all love. Appreciate the love. I appreciate that. So I gotta answer your question. In short, does the underwriter need a letter from the loan servicer regarding my student loan payments, or will what the credit report is stating suffice? Will they check this again before closing, and what are the parameters on this second check? That is one of the best questions I've had asked on student loans, right? That is one of the best questions that I've had asked on student loans. So give me a second. I'm going to answer that for you. The underwriter, oh, no problem. I appreciate the love. The underwriter can do a few things. The underwriter can take what's on the credit report, but if the payment on the credit report is 0 and you're doing FHA financing, they're going to automatically use 0.5% of your student loan debt, and they're not going to check a second time. If you're going conventional financing and that same student loan debt report says 0 on the credit report, they're going to use 1% because they don't have anything. If you have a letter for student loans and so let's say you have $100,000 of student loan debt, they use 0.5% on FHA, that's $500. Or they use 1% on conventional, that's $1,000. But if you have a student loan payment letter that says Anna All Love is going to use her income-based repayment plan that she pays $250 a month on, then they can use that $250 a month payment. What they do is they take the letter and they review it. If the letter has the right information and date on there, then you're good. There's no second check and no check behind it, right? Sometimes if you get a letter and when you get the letter, it's expired, then you have to renew it. But once you have the updated letter, there's no second check behind that as well. But the payment has to be put in place. You don't have to have made a payment on that, but the letter has to check all the boxes. And as your lender, I'm going to check and see, okay, when I pre-approve you, I'm going to ask for the student loan repayment letter. We're going to have that conversation because then I have an understanding of what we're going to use. Are we going to use 0.5%? If you're going conventional and your payment 0, you have a letter for 0, then we don't have to use one. Use a Fannie Mae. And if we're going FHA, and your payment, you don't have a letter, then we'll use 0.5%. And when I'm pre-approving you, we'll factor all that in. So I like to get that information up front because when we pull credit, we're going to see the student loan debt, and that's going to get me asking questions on it. Hopefully that answers your question. If you have more questions, then that's fine. I see it. It says, yes, I can do New York City. I can definitely do New York. and it says, so they need a letter. They can't use what the credit report is stating. They can use it but what if it's not to your benefit? It just depends. We try to use what's to your benefit. So if what's on your credit report is beneficial to you, then we can use it. If it isn't and we can do something better, I'll try to put you in a better position on which way we go. So hopefully that made sense. But yeah, thank you. Thank you. I definitely appreciate that. Appreciate it. Guys, that was a great question. I'm going to do something. If you're out there, and you have other questions that don't pertain to the rates dropping, you can definitely ask them. Hey guys, since you see I do accept super chat, I appreciate it though. I definitely, appreciate any love that you guys send, whether it's $1, $2, 50 cents, I take it. I appreciate it. But if you have any additional questions, definitely let me know. And I will definitely answer it for sure. So kind of reset the room. We're talking about interest rates dropping. We're talking about how it affects you, how it affects the economy, how it affects the economy, how it affects what's going on, how I can help you, what do I see in the market. We're just kind of discussing what rates affect with the cheaper, prices, cheaper interest rates, lower interest rate. I'll get to you, Miss Johnson. How you been? It's been a while. And I'll answer your question. When is a good time to lock the rate when you're 2 weeks away from closing? Right away. Because if you wait too long, it triggers certain things not being able to happen because your rate's not locked. You can't get it clear to close because your rate's not locked. Your closing disclosure can't go out because the rate's not locked. Of course, you can't go to closing if you don't have the closing disclosure and the rate's not locked. And then if you wait a week, it could delay something because there's certain documents that can't go out. So if you lock your rate, you get something called a loan estimate. You get your lock sheet, you get your loan estimate. You get your loan estimate, that's 24 hours after the lock. 24 hours have to go by before the CD goes out. So if you do that on Monday, you close Friday, you do the rate lock on Monday, the CD, the LE loan estimate goes out on Tuesday, and you got to have 3 days. If anything happens after that 3 days, the CD can't go out till Wednesday. You don't close on Friday. It pushes it till Monday. So for me, I would try to lock as soon as possible. It's Russian roulette, right? If you wait to see if rates get lower and they increase, then you like, I should have locked. But if they decrease, well, you know what? I missed out on it, but they didn't increase, and I'm good. You said, what if the house is not complete yet? Doesn't matter. If they have a time frame, unless 2 weeks out and they haven't told you there's going to be a delay, they're probably still pushing to get it closed in the next 2 weeks. But I would lock next week and be safe. Rather safe than sorry. Hopefully that answered your question. Is there a borrower can kind of ballpark how they will be approved based on income credit? It's tough on how much they can qualify for. You could do like a mortgage calculator. You could probably do a mortgage calculator, but it's probably just apply. I know you might not want the credit hit, but probably go ahead and apply and just get an idea. Because then you'll know what your debt to income ratio is. Max, um, max DTI that you can utilize, even with the best score you can get on FHA, is 56.5, depending on what you're doing. It rounds up and rounds down, right? But if you, and that, most likely you can get approved. You got the down payment, closing costs, or where those funds are coming from. 580, you're probably not going to be able to go 45 back in ratio unless you have a 401k or some type of reserves, then you have money, right? 640, you may still need 2 months reserves, depending on what you have on your credit, what your debt to income ratio is, the length of your credit. So it's very hard to determine what you can qualify for, even a ballpark, because you may not get approved through the GUS system. Even if you got a 640 credit score, you may not GUS through the underwriting system, AUS or LP. So you could ballpark it by looking at a mortgage calculator, but make sure it's a mortgage calculator that has estimated taxes and insurance in there. Hopefully that answers your question. Ms. Johnson, if I didn't say congratulations on being under contract and you guys getting ready to be homeowners. Since the house is finished, new construction, is it a subdivision or did you guys build with your own builder? Mia, I purchased my home in August of 2023. So yeah, it may be a good time to refinance. In the course of that time, you may have taken on some additional debt that you might want to refinance. If you got equity into your property, may not change your monthly payment for your mortgage, but it might change your total payments of what you're paying out. So it would be advantageous to see about refinancing and see if it's helpful. And if you have equity in the property, let me not skip people. I'm gonna get called out again. Hey, how are you? Do you normally see buyers refinance 6 months after closing and rates are lower? I got a 6.25. When would you refinance? 6.25, 210 days from the date that you purchased the property. If it was FHA, typically rule of thumb, if you can go down 1%, it would make sense to refinance. So if we can get a rate of 5.25%, we potentially could refinance and see if it made sense. It would be tough to do a streamlined refinance probably, but you could probably do a rate and term refinance. What difference between the two? Rate and term refinance, you have to get an appraisal, the hard credit pull. Streamline is a mortgage credit pull, no appraisal, but streamlines have to be very specific in order to come into close. The rule of thumb is to have the buyer come into closing with just either 1 or 2 months of their mortgage payment to get the lower rate. I think personally that rate and term refinances are better, even though it costs you an appraisal. Some of that money can be rolled into your closing costs. The closing costs can be rolled into your loan, and we see if it makes sense, for you to pay that to save money, or you could do, pay down some debt in that rate and term refinance, and you can get up to $500 back. So you might be able to get your appraisal money back based off what the appraisal come in and what we can loan to you. Subdivisions, all right, that's awesome. Acacia, hopefully I answered your question. Acacia, did you get new construction? Probably not with 6.25 interest rate, but congratulations. I think I seen you post on Shahida's page that you purchased in Douglas County or Douglasville, one of them. But congratulations, my friend. Why do lenders have different rates but are willing to compete for the business if necessary? What's the real scoop on that? Each company does business differently. Each company has a different appetite for certain type of loans. So there's companies that take lower credit. Some want to take mid credit and higher. Some want higher credit scores. Why the rates are different? Because of the type of business that they want to do, right? There's companies that say they have lower rates, and they do, but you have to pay for them, right? If you, for instance, you went to a subdivision, so there was probably an incentive from the builder and the builder's lender for you to utilize them, the builder's lender, right? So they already have cushioned in money to give you for closing costs, and then that lender is also taking less compensation in order to get the deal because they'll get deals from that business. So, okay, cool. Right there, that's how they are able to offer the incentive. If you come to another lender and they said, hey, we'll match what the builder's doing after they find out what it is, because they're trying to keep that business. So they say, hey, I'd rather take some than none, but somebody's losing out in terms of compensation. And that's essentially what it is. It boils down to, can we make money off this person, or do we just let it slide, right? Do we let it slide because we can't compete? In most cases, on a deal, a mortgage lender doesn't make $10,000, $15,000. If the lender for the builder's if they're combined giving $15,000, it's no way nobody can match it, because typically in those cases, the builder has built the house, of course, they've cushioned in for your $10,000 inside of that price you paid, and they probably own the lender, so they can take less of a margin because they make more off of the house, and then when they sell your loan off to somebody else, they make more profit. So hopefully that makes sense. But it's just like you can go to a two Lexus dealership and get the same color Lexus, same model, same make, and one may be higher than the other. It's pricing. It's just what they're willing to sell, what you're willing to pay. There are so many stories lately about wire fraud. It's very scary how sophisticated the fraudsters can become. Just curious as to why certified check isn't also accepted for closing. Great question. So there are a lot of scammers, fraudsters, sophisticated people able to gain information to possibly get wires sent to them. Why aren't certified checks used anymore? Because what did the banker tell me? They're no longer certified checks, they're cashier's checks. A person can go to closing, take the check for closing. Let's say they got $20,000 for closing. They can go to closing. The attorney's office has the check. You signed off on a document. You're happy. You had the champagne pop, balloons everywhere, confetti, boom, closed on your home TikTok video, everything. You leave and you call the bank and stop payment on that check because you can. Then the attorney's office is out of that 20 grand, and the seller don't get that 20 grand. That's why they don't use certified checks. That's why they don't use cashier's checks. I know here in Georgia, it daggone there gotta be $500 or less before they'll take a check, because they run the attorney's office runs the risk of losing a lot of money. But in terms of the fraudsters, you just gotta be very cautious. You got to do your due diligence as making sure that that's the email that you receive emails from. You get it from the attorney's office. You make sure you get the wire instructions directly from the attorney's office. When you go to the bank, I would call and make sure these are the wiring instructions for the attorney's office. And then when you finish sending the wire, I would call the attorney's office to make sure that they received it. Yes, it's a lot of steps. No, we shouldn't have to do that because we worked hard for that money, but scammers are just going to try to get you. So that's the story about the certified check. With paper checks, the buyer is getting it in hand and bringing directly to closing, less risk being intercepted than the wire can. Right, but you must have put that when I was talking. But they can cancel that check. They can stop payment on a check. So, some buyers are scammers. Some scammers are buyers. You know what I mean? Like, you'll be amazed at what people do. You'll definitely be amazed at what people do. We had one where the buyers I heard the story where the buyers went to closing and nobody did checks and balances, and to find out the buyer hadn't wired their funds, and it was hard to get in contact with them. So, buyers are, you got to beware of buyers because, they can be scammers, or, scammers can come in the form of a lot of different things. I came late, but the rates dropping really make a dent. Did the rate drop really make a dent for buyers? Saw an article about the rates dropping being clickbaited. So not really. When the Federal Reserve drops interest rates, it does not have a direct effect on mortgage interest rate. We'll see a direct effect on the mortgage interest rate probably in a couple of weeks. It does affect credit cards, student loan, any other kind of personal debt you have, right? July 31st, a report came out, or sometime in July, the Federal Reserve Chairman Jerome Powell said, hey, the economy's doing better than we thought. Jobs are doing better than we thought. Inflation's coming down close to 2% where we want it. We're probably going to look to making a cut here soon, right? So as mortgage companies, we kind of seen how the market played out, and they began to take down the pricing. So the pricing that buyers thought they would see or think they would see because their federal rates drop was already priced in to our loans. So whatever you thought you were going to get after today, mortgage companies had already priced that in because it was anticipated that interest rates were going to drop. So they passed on the savings early because the market reacted positive. Went resale, congratulations. Thanks to me and Shahida, you finally made it. Appreciate it. We didn't use that lender. Okay, cool. Hopefully you got a good rate. Got it. Yep. Why are you crying, random user? Is that a laugh or a cry? One last question. It says, wire transfer taxes on a closing estimate for a new bill. Illinois does taxes in prior year. And the prior year, those were only land. Because if you do only land and the prior year was only land and you don't have those taxes in there, you're going to see a jump in your mortgage payment, and then you could be like one of those videos where the people say my mortgage payment jumped $500, and I've seen some of those videos, and some of them have come out of the Chicago area, Illinois area. So it just all depends, and if it could be on the estimate. It might not be on the final, but what I would do, Cynthia, is I would ask the attorney and the lender about those taxes and get a better answer. I'm somewhat familiar with Illinois. I've closed deals in Illinois, refinances, resales, but I haven't done a new construction there. So I'm just assuming based off what I've seen in different states with the new construction piece. No problem. I appreciate it. Keep supporting me. Keep jumping on the lives, asking your questions, even after you finish. It says I was laughing at some of the buyers. Yeah, they are. Yeah, I could tell you some stories, but I won't. I've seen some stories. Um, I've experienced a few things as well, so definitely they're out there. Yeah, man, Cynthia, I think I seen a video, like a news video, like real news, not somebody just making up something, where they interviewed the guy, and I think his taxes went from a couple $100 to a couple $1,000, like total. Like it was like, I think they might have went up 10 times, and I think it was in Cook County, and it was like in the city limits of Chicago. So yeah, Chicago seems to be expensive on taxes. Anna, all love. Do you do mortgages in NYC? Yes, I do. Does your organization do fully underwritten pre-approvals? We can, depending upon, I'm with a broker, so we can, depending upon which lender we go with. But I will say that even if we don't do a fully approved underwriting, I ask a million questions. Typically, if a loan doesn't go through, it's because the buyer doesn't have the money, or the house didn't appraise. Shanitha. Shanitha. Thank you. I'm sorry. I apologize. Shanitha. I'll put some respect on your name. It says, hey, Kevin, at the pre-approval, you get an interest rate. Now the interest rates have been cut at the time of purchase. Would the pre-approval rate be used, or would it work based on the time? It would work based on the time. So what I've been doing since rates have dropped, I went back to some of my clients. If they're using their own funds, then I've been going back to clients, and I've been going back to look at clients to see what the new interest rate would be for them, reaching out to them. Hey, rates have dropped. You could do 350 before. Now you can do 375 because there's been a drop in the interest rate. Here's the updated pre-approval based off of what I have. That's if somebody needs to qualify for more. I do the same thing if they're not rate conscious, but if they're payment conscious, let them know, hey, you can go up a little bit more and keep the same payment because interest rates have dropped. If you're using a down payment assistance program, most of the time those down payment assistance programs rates don't adjust the same way as the regular market. So if you're using a down payment assistance program and you pre-approved with one, it's going to be about the same. It's not going to change unless there's a significant change in the rates, which it has, but the down payment assistance programs have their own method to their madness, so they don't adjust every day like the normal mortgage rate. So hopefully that answers your question. We're under contract with a new bill. What's going on, Thurman? Man, I don't know when the last time I had a question from a gentleman. Unless somebody is under a different name, I don't know where the brothers and brothers at. My brothers ain't been asking no questions, man. All my brothers, Spanish and white, black brothers, all of them. No, y'all guys hiding out at. We're under contract with a new build. We're doing an FHA loan with interest rates dropping. Is it a great idea? Is a great idea you use incentives money to buy down the rate, or use the money for closing? I would potentially ask my lender if I could do both. Is there, if you have funds for closing, seeing if it would make sense to spend some of those funds to buy down the interest rate, and what that cost looks like, and then you bringing some more of your own funds to closing. But yeah, if how you use your closing costs, it's a case by case. It's a scenario where you would just have to double check and make sure the numbers made sense and how long it would take. But it's not a bad idea to use some of the funds, the builder's fund. I mean, some of the incentive money to buy down the rate. Congratulations on being under contract as well. How does the mortgage broker thing work? That's where you shop different lenders for the buyer right. So who actually ends up owning and servicing the loan? So the whoever we process the loan and underwrite the loan through ends up funding your loan. Now, 9 times out of 10, most loans are going to be sold at closing. So who funds your loan may not be the same person who owns and services it. Whoever buys that loan from that broker or even regular mortgage company, they would still have to honor all things pertaining to your loan. Interest rate doesn't change, time of your loan doesn't change, payment doesn't change, unless the taxes and insurance increase. So whatever terms and conditions you sign at closing remain the same. If ABC Mortgage buys it from 123 Mortgage and then they sell it, it just depends. And that's a good question. Mortgage companies use a line of credit to fund loans. And when they use a line of credit to fund loans in a market where they start to see a ton of sales or refinances, they have to free up capital from those warehouse lines. And by freeing up capital, they have to sell some of those loans off so they can fund more loans. That's one reason why your loan gets sold. Sometimes in a market like we were coming out of, and mortgage companies weren't doing as many loans, but they needed capital, they would sell off loans so they could have more money to operate. So there's reasons why loan companies buy and sell loans. So example, you may have went to Wells Fargo, may have went to a bank, and they didn't approve you, but they end up being your servicer because they buy loans on the secondary market because somebody else was able to approve it. Prime example, Chase Bank. Chase Bank does not do USDA loans. However, they're one of the largest servicers of USDA loans. Go figure, right? So it just all depends. But 9 times out of 10, there's a huge chance that your loan is going to be sold multiple times while you own it. Hopefully that makes sense, random user. Yes, Illinois is expensive. I was born here, purchased a home here, an emergency fund, and having a stable career is the way to go. That's in any part of the world. Having an emergency fund and the savings, all of that stuff. Life is expensive. Life is definitely expensive. Meaning, for instance, if you go with Rocket, then they own and service the loan versus with a broker. How does that work? So let's use Rocket because you said it. So if I broker your loan and we use Rocket, I do the pre-approval. I make sure Rocket underwrites, processes, and funds your loan on time and properly. So I'm managing that loan because you're my client. Once you close on that loan, Rocket then becomes the servicer. So you make your payment to Rocket, but sometimes Rocket sells their loans as well because they have to. I got to charge my computer. They have to, use their warehouse line of credit as well. So in that case, you broker to me. I would guide you through the process, get you from A to Z, close on your loan, and you make your payments to Rocket. Now, you could always reach back out to me, and you're my client. So Rocket may be servicing your loan, but I'm going to be the person that try to keep in contact with you, maintain that relationship with you. I want to be your go-to guy to come back to. That's the way I try to conduct business when I work with clients. So that's how it works, So they service it, they own it. I brokered it because I pre-approved you. And then we just send it to them because they may have the best rates and terms. And not always just rates. It could be they just had the best terms, and the rate could have been very close to somebody, but for the time frame that we need to get it closed, they were able to do it faster. So all of those things play a part in it. Um, play a part in your approval process. Okay, cool. So, if you're watching the replay or you just joined, we're discussing what does it mean when rates are dropping? Not near you. I was typing too fast. But what does it mean where what does it mean that the interest rates have dropped? The Federal Reserve have dropped interest rates. What does that mean to you? That's what we discussed in this video. If you're just joining, there were some amazing questions asked today. I would go back and watch the beginning. We will also have timestamps as you can go to a specific question that you may be interested in. Couple things that I didn't ask for. If you're watching this video and you're gaining some valuable information out of it, do me a huge favor and give it a thumbs up. And then the next thing is if you're new to the channel and you have not yet subscribed, do me a huge favor and hit the subscribe notification. Me and my team definitely appreciate it. Also, a couple other things. In the description below, you will see a link to my Facebook group. I would love to have you join it. Also, a link to our newsletter where we send out information twice a week, sometimes 3 times, in order to make sure we stay in contact with you, build community, help educate you outside of me going live and posting videos. And you'll get emails if you miss my video or you miss a live. We send you information so you can click on it and watch the video because you may not have gotten a notification from Instagram. From YouTube, I'm sorry. What percentage on average are brokers' fees for their services of the total home price? I don't know. It varies. Sometimes broker fees are less expensive than regular mortgage companies. Lately, I've probably been seeing it be kind of competitive with both, depending on what type of mortgage company you go with. But at the end of the day, I've worked both. I've worked retail and I worked as a broker. Your loan is only as good as the loan officer you work with. Because, for instance, you can call Rocket Mortgage on the phone and get someone, and they'll give you a rock bottom rate, but they may not be able to close your deal. And if they can't close the deal, then they can't give you that low rate. So, when you're working, yes, rate plays a difference. It makes a difference in your payment, makes a difference in what you qualify for, but you also want to make sure you have a lender who can get you to the finish line. I've been beat out by lenders and the buyers, and the realtor came back because the lender couldn't get the deal done. Or they came back because the lender lowballed them on what the rate and closing fees were and ended up being more than what I had quoted. So they came back to try to save some money. So, guys, a couple of things. Don't fall for the banana in the tailpipe. And make sure when you're comparing, if you compare lenders, compare apples to apples, oranges to oranges, meaning comparing the same thing. Not only that, is it worth an extra $1,000 for you paying? And I'm just making up a number, right? Is it worth you paying extra $1,000 for closing if you know you're going to get to the finish line with a person that can answer your questions versus paying $1,000 less and the person can't answer your questions, non-responsive, and you don't get a good feeling as you're going to close the loan? It just kind of all depends. I truly believe sometimes you get what you pay for. I'm not saying pay high amounts for closing because you'll get better service, but if you don't always want the Dollar Tree experience when you're buying a home. Sometimes go middle road, you want Target experience. You don't have to have Saks Fifth Avenue when you close, but you want to make sure that you're being taken care of. Your loan officer's knowledgeable. Not just your loan officer, your real estate agent's knowledgeable. I'm there to help you. I've heard horror stories where the realtor and the buyer fell out and the realtor did not come to closing because they didn't want to see the buyer, or the buyer asked the agent not to come. So when you're in this process and you're working with people, you want to make sure you get people who are professional and that can help you. And at the end of the day, you want to make sure you're doing your part as well, because pre-approval is just one portion of the loan. Getting pre-approved is just a small part of the process. It's a great hurdle that you've leaped, but then when you're under contract, it's go time. Underwriters are digging more into your assets. They're digging more into your credit. Has this person made any late payments since we've been under contract? What's this on their credit report? Why are these charges coming out? Their income look like it's dropped. Where's their money coming from? Their money no longer looks like they have this cash. Why was this money deposited into their account? Why is it cash? Where'd they get this $20,000 from? It's undescript, it's unaccounted for. They don't make $20,000 a month. Is it 401k? Where's their 401k statement? All of those questions, we're not interrogating you, but we are getting questions answered so we can get you approved, because not only do you have to meet the guidelines, this loan has to be sellable on the back end market, or we're caught eating it, or FHA, VA, USDA won't back it and guarantee it. Fannie and Freddie Mac and Ginnie Mae may not guarantee their loans or back the loans either. So we have to make sure we dot our I's and cross our T's. And when we're under contract, we have to make sure we get all of our questions asked. Each underwriter is going to be different. And with the underwriters being different, they're also going to, there may be times where me as a lender, I may have to ask them, hey, I know you said on this guideline they need this page, but here it is. We've already provided a reason. Is that good? Or, hey, I understand that we need to do this. What do we need to give you to help us overcome this obstacle? So it's go time. It's no playing around. It's a tedious process. I know you hear people say it was seamless. The deals that are seamless, the ones that are seamless are the people who do their business a specific way and they don't deviate from it. It's not a bunch of money moving back and forth from accounts. They don't have a bunch of things going in and out. They got a very simple and easy life, or not easy life, simple banking life, or they're able and know where the documents are for everything we ask, which makes the process easier for them because they know where it's at, and it's easier for us because we can get it quickly. So, so guys, I appreciate you for hopping on. I see we got 19 people out in the crowd. I appreciate everyone for sticking around this long. I am willing to stay and take on 2 more questions if you have them. If you got 2 more questions, cool. If you got 2 more questions, cool. I appreciate it. Come on, Anna Love. Hopefully you're not spending your closing costs on these super chats. No problem. So to go into rate, is it possible to be offered a 6.25 rate without points and then go buy down points at 4%, whether or not break even time frame is favorable or not? Is there a buy down point limit? That is a great question. So there's something called high cost. And with high cost, they won't allow for a mortgage company or a buyer to spend too much money on, getting better rates in terms whether the buyer wants to buy or whether the buyer wants to buy down, or if that's what it is based off the buyer's circumstances, right? It's called high cost. High cost is typically based upon your loan size and amount. Lower size loans, it's tough to buy down rate. Higher price ranges, it's a little bit higher, but the ability to, so if you were offered 6.25% at par, What par means is the closest to 100% that you can get. You might pay $300 for par. You might pay $1,000 for par, but that might be the closest to par. So let's say 6.25% is the closest to par that you can get, right? And you say, I'd like to try to buy the interest rate down to 4%. Honestly, you're to buy that rate down to 4%, and I'm not even looking at a rate sheet, that's probably going to cost you in excess of 20 grand, and that won't happen. But you can say, hey, what's the most I can buy my rate down to where I don't run into a high cost issue? And then you can decide if that's what you want to do. If you're looking for a rate at 4%, you could potentially do a couple of things, right? You could do a rate of 6.25% if that's your par. And then if the seller's contributing closing costs, you could ask to do a 2-1 buy down or 3-1 buy down. What does that mean? If you rate 6.25% and you do a 3-1 buy down, then on the first year of the 3-1 buy down, your interest rate will actually be 3.25%. And then on the second year, it will be 4.25%. And on the third year, it will be 5.25%. On the fourth year, it goes back to the 6.25% that you were given at par, and it stays there. It doesn't increase after that. So what you're doing is you're using some of the closing cost assistance that the seller was giving to buy the rate down to alleviate some of the mortgage payment for the first 3 years. So you can do 3-year buy down, 2-year buy down, 1-year buy down. I've got a client right now. They did a 1-year buy down, and when rates drop a little bit more, we're going to refinance them so they can have that rate locked. Now, in the course of doing the 3-2-1 buy down, if rates get to a point, let's say in 2 years, rates get to 4.5, I would refinance to that 4.5. The money that's left over from the 2-1 buy down helps pay down the principal, and then the rest of your loan, you'll start over 30 years typically, but your rate will be 4.5% for the remaining balance of your loan. Hopefully that makes sense, all love. All right, cool. I was hoping I might have to cash app it back to you because I don't want you wasting your down payment and closing costs. Yep, your loan got stolen a month after closing. Matter of fact, I had a client reach out to me this week, and her loan got sold the day of. No, it got sold a month after closing. So, same as yours. Actually, the same as yours. Now, I've had some clients who got their loan sold before at closing. It was a different company that was going to be servicing. It just so happened that their loan was bundled in a group of loans that they were selling off. They had a new servicer after closing. They made their first payment to someone else. What are some excludable debts can boost your buying power? That's a great question. Credit card debt, car payments, personal loans, that's pretty much it. Like credit card debt, car payments, personal loans. If you currently own a mortgage, of course, getting rid of that payment by refi or selling off the house, that helps. Student loan debt, maybe going back to the servicer and saying, hey, is there a way I can lower my student loan payment? Paying down credit cards, paying them off, different things like that. Making more income, of course, that helps boost, when if someone gets a second job, I always tell them, don't look at the second jobs don't make you rich. I don't know a rich person that has a second job, but second jobs also take you away from your family, your loved ones, and take away your free time as well. Not saying that I'm against second jobs, but if you're doing it, do it with a purpose. Meaning, you want to make sure that you are using it to pay down debt, because it's not going to help you qualify for a mortgage unless you've had it for 2 years simultaneously with the other one. You want to be able to use those funds to save for your down payment and or closing costs. So checking your credit cards, paying down those balances, seeing how much longer you have for your automobile payment, whether it's car, truck, van, and then any personal loans that you may have, that could help boost your buying power and lower your debt. Hopefully that was helpful and answered your question. Let me know. I don't even want to mess that up because Shanitha didn't check me today on her name. So 7474. Let me know if that answered your question. Again, guys, I appreciate you. I appreciate the love today, the super chats. I appreciate the questions. I think this is the longest I've ever done a live, almost an hour and a half. I told my wife that I one day want to see if I can do a marathon live. Start early one day, see how long I can go. You know, I mean, you may see me on here eating, taking a break, but I want to see how long I can go in a live. Again, guys, I appreciate you. If you have any questions, do me a huge favor. Drop them below in the chat. I'm about to go put my kids to bed. Thanks for coming out. I appreciate you. And if you're watching the replay or you stayed till the end, thank you. Go back to the beginning and rewatch it and share it out to a couple of friends. Good night.